So another question that I get asked quite often is, what are the top dividend stocks in my portfolio? So I went through and I had a look at all the current dividend yields for all my stocks, and I've picked the top 3. I was going to do the top 5, but then it would be a really long video. So top 3, and if you want me to do some more of these, let me know and I will do follow-ups. So yeah, I'm just going to take you through the top 3 stocks, and we're going to look at some analysis of them on the websites that I use, and yeah, let's get into it. So the first one, perhaps unsurprising, but it's AT&T. AT&T currently has a dividend yield of 7.2%. Now, if you weren't aware, AT&T is the world's largest telecoms company and the second largest provider of mobile telephone services. As of 2020, AT&T was ranked 9th on the Fortune 500 rankings of the largest US corporations, with revenues of £181 billion. It is a constituent of both the S&P 500 and the S&P 100, and it's been around for 37 years. So if we look at Simply Wall Street first, it does seem like they think that the stock is currently undervalued by 73%. Now that is significant. That is so much. So in terms of dividends, it does seem like their dividends have been fairly stable for the last 10 years. And although at the moment it seems like the current payout is not covered by earnings, they are saying that the future dividend coverage is expected to be covered by earnings in the next 3 years. Now, in terms of their financial health, the short-term assets don't cover the short-term liabilities or long-term liabilities, but the long-term assets do. We can see here that in 2018, they managed to start really bringing down their debt-to-equity ratio, and it only started going back up again at the end of 2020. So after everything that's been happening in the world, I'm not holding it too much against a company when that's happened. So hopefully they will continue to bring that back down going forward. So let's have a look at Genuine Impact next. So if we filter it on just the communication services sector to make it a bit fairer, and we apply that filter, we can see now that it is out of 356 stocks, number 192 on quality, number 36 on value, so pretty high, and number 157 on momentum. And on the checklist, we can see here that it's got mostly top ratings for value, ESG, dividend strength, share price stability, liquidity, and size. And then the only fails it seems to have is the historical return and expected growth. So in terms of quality, the profitability is high and the capital allocation is very sound. It's just the financial strength that seems to be weak at the moment. In terms of value, it is again very cheap, so that is very consistent with what we saw previously on the undervalued ratings. So that does suggest that potentially there is some value to be gained out of buying the stock. And then in terms of momentum, we've got revenue medium, earnings weak, and sentiment strong. So on the dividend strength, which is what this video is about, we've got number 53 on dividend strength, which is very high. The dividends per share, dividend yield are both very high, and the dividend cover is high. And we can see here on the beat/missed consensus history that they beat their revenue expectations currently, but missed their earnings per share. But they do have earnings coming up shortly in the next couple of days. I think even potentially on the day that this is going up. So we'll see how that fares. Now, this is a really interesting new feature. We've got the analyst ratings now on Genuine Impact. So at the moment, we can see out of 31 analysts, 19% are saying that it's a sell, 52 are saying it's a hold, and 29 are saying it's a buy. So make of that what you will, but this is a really cool new feature that I really like because they never used to have the analyst ratings. And the other cool thing is we've got the reporting date, which you can see here is July the 22nd, which is where we're expecting those earnings, and ex-div date, which is July 8th, which has obviously gone now, so it's a bit late to get in for now, but the dividends will be paid on August the 2nd. So let's have a look at some more analysis now. So the final place that I look at is TIPRANKS. So we can see here on their smart score, it is forecast to outperform the S&P 500 because the smart score is 8, so just about on the lower end of the outperform rating. And what's interesting is the insider activity has been trending to buying shares in the last 3 months. So we can see here that in the last month or so, we've had so many buys, and in the last 3 months, corporate insiders have bought shares worth 4.6 million. So I think that's really, really interesting. But in terms of analyst ratings, if we filter on top analysts here, we can see here that 9 ratings have been issued here in the last 3 months, and 4 of them have been buy and 5 of them have been hold. So a potential 17% upside here according to the price targets. Now, if we filter on all analysts, it becomes different. It becomes a hold rating. So it depends where you want to place your faith, I guess. If we do have a look at the stock chart for AT&T, we can see here that in 2020, it did crash significantly and it hasn't quite built back up yet. So there could potentially be some potential there. Obviously, it was growing consistently until 2020. Okay, so the next stock on my list is GlaxoSmithKline with a dividend yield of 5.6%. GlaxoSmithKline is a British multinational pharmaceutical company, and it was established 21 years ago in the year 2000. It is the 10th largest pharmaceutical company and number 296 on the 2019 Fortune 500 list. Now, it is a constituent of the FTSE 100, and in 2016 it was the 4th largest on the London Stock Exchange. So let's have a look at what GSK is saying. So it does seem like GSK is undervalued according to Simply Wall Street, so 59.6% undervalued. They are forecasting a 13.2% annual earnings growth. And similar to the last one, the short-term assets don't quite outstrip the short-term or long-term liabilities, but the long-term ones do. They do have a very high dividend compared to other dividend payers in the UK, and they are in the top 25% of dividend payers in the UK market. They've had stable dividends for the past 10 years, and their current dividend payout ratio is already covered by earnings. So the current payout ratio is 76% and forecast to be about 45% in the next 3 years. Okay, so let's have a look at genuine impact again. So out of the other healthcare stocks, so 1,200 stocks, it is number 453 on quality, number 118 on value, and number 1,092 on momentum. So maybe not doing so well on the momentum, but pretty good on all the others. So on the chart here, we can see here that momentum and expected growth are the only ones it seems to fail at, and it's actually in the top 20% for the majority of other things, including dividend strength and accounting strength, etc. So the quality looks to be rated quite high, the profitability is very high, the capital allocation is very sound, and financial strength is very weak. On value, again, very cheap, so it does seem to be saying that it is a buy at the moment. So the income statement, very cheap, balance sheet cheap, and cash flow very cheap. Momentum, like I said, very weak on momentum at the moment. But we can see here on dividend strength, it is very high across the board. The dividend yield is actually number 2 across all of those healthcare stocks. So in terms of the revenue and earnings per share, again, one is miss, one is beat at the moment. Only 7% of analysts are saying that this is a sell, 55% are saying it's a hold, and 38% are saying buy. So quite a high amount there saying buy as well. Their reporting date is July 28th, so that is quite soon. So it'll be interesting to see how that impacts the share price and the momentum. Okay, so let's have a look at TIPRANKS. So the smart score is 9, which means again, it is forecast that it will outperform the S&P 500 returns. And it seems like the hedge fund activity is increasing quite a bit as well over the last quarter. If we have a look at the stock charts, again, massive drop in 2020, hasn't quite recovered to the pre-2020 levels yet, and it was consistently going up prior to that. So the final stock I want to have a look at, and the third on my top dividend yielding stocks, is the National Grid. The National Grid has a dividend yield of 5.2% at the moment, and in case you're not aware, the National Grid is a multinational electricity and gas utility company, and its principal activities are in the UK, where it owns and operates electricity and natural gas transmission networks, and also in the northeastern United States, where, as well as operating transmission networks, the company produces and supplies electricity and gas. It is one of the largest investor-owned utility companies in the world. It has a primary listing on the London Stock Exchange, and it is a constituent of the FTSE 100. It was founded 31 years ago. So again, it appears to be undervalued according to Simply Wall Street. It is forecast to grow about 8.9% per year. It has a pretty healthy financial health. The short-term assets exceed the short-term liabilities, and the long-term assets outstrip the long-term liabilities as well. Now, they do have a very high debt-to-equity ratio, so 157%, which is very high. But in the past 5 years, they have reduced it from 222% to 157%. So they are working on their financial health. Again, they are in the top 25% of dividend payers in the UK, and they've had a stable dividend for the past 10 years. At the moment, the dividend payments are not well covered by earnings, but similar to the first one, they are forecast to be covered by earnings in the next 3 years. So if we have a look at genuine impacts against the utilities companies, so out of 192 stocks here, it is number 112 on quality, number 67 on value, and number 39 on momentum. Now you can see it's mostly neutral in the majority of things here, and top 20% only in share price stability, liquidity, and size, which is really interesting. The quality seems to be medium, the value cheap once again, so it does seem like all three of these stocks are currently considered quite cheap on the market. The momentum is strong with this one, and the dividend strength is high. So dividend per share is high, dividend yield very high, but dividend cover is low. Now, out of 16 analysts, 100% of them have said that this is a buy stock right now, which is really, really interesting. And if we have a look here, their reporting date is November the 18th, so still very, very far away. So let's have a look at TIPRANKS for National Grid. So we can see here that out of the analysts as well, 9 out of 9 in the last 3 months have said this is a strong buy stock. If we have a look at the price targets here, all of them are above the current price, which suggests a potential average upside of 12%. Now, if we select top analysts, then 5 out of 5 have said buy as well. Now, the smart score is neutral, which means it's probably not likely to outperform the S&P 500. But I don't see the National Grid as much of a growth stock. It is more about the dividends for me. So Not really surprising that it's not going to outperform the S&P 500. Now, it is nearing its pre-2020 levels now, almost at an all-time high. Hasn't quite reached there yet, but you can see that consistent growth over time. Even if we go back 5 years, since about 2018, they have consistently been growing. Now, this video was very kindly sponsored by Genuine Impact. You guys know I use them. I've mentioned them in previous videos. I did a review with them a long time ago, but they do have a really cool new feature, which is this important dates feature that you see here. So when you add stocks to your portfolio on Genuine Impact, it shows you the important dates coming up. So you can see here that for me, Johnson & Johnson are actually reporting earnings on the 21st, which is only a few days away for me as I'm filming this video. And then AT&T, again, as we mentioned earlier, are reporting earnings on July 22nd. Alongside Unilever as well. So absolutely love this. It means that I can stay on top of what's happening with my stocks without having to go trawling and figuring out when it's happening. So really like this, and it actually shows dividend dates as well. So ex-dividend dates and dividend payout dates. So we can see here, for example, for me, ex-div date for Realty is on July the 30th. Okay, so that's it for this video. I would love to know what you think of these 3 holdings and whether you have any of them in your portfolio. Let me know in the comments below, and I will see you next time. Bye.